Hello friends, welcome to this particular video on certificate examination in risk and financial services. I have received some emails from my subscribers as well as viewers that I should prepare a video on certificate examination in risk and financial services as they have exams in the coming weeks. Considering their request, I have decided to create a video with 20 MCQs. Now these MCQs are not from any particular chapter, but they are from the entire book of IIBF on risk in financial services. So basically the book on risk management is what I have used for the purpose of creating this MCQ. Let me quickly take you to the 20 questions that we have. So the first question is, which of the following are objectives of measuring and quantifying credit risk? So when you measure and quantify credit risk, you work with certain objectives. You have been given three options here. Contain and control the risk. Is that an objective? Price the credit exposure on a scientific basis. Is that also an objective? And manage and control credit risk through effective loan review mechanism. In fact, all three are objectives. So, as part of the discussion, we will go ahead with the answer C. So, all three objectives are used in measuring and quantifying credit risk. We move on to question number 2. What is the minimum additional tier 1 capital that banks are supposed to maintain as per RBI Basel III guidelines? So RBI and Basel guidelines says that banks need to keep tier 1, additional tier 1 and tier 2 capital, out of which additional tier 1 has to be 1.5% of the total capital of 9% as prescribed by RBI. So here we are going with RBI guidelines, not with the Basel. Basel has a slightly different guideline than RBI. Okay, so we will use 1.5% as per RBI. Now, when the rating of a borrower moves from AAA to AA, this becomes an example of what? So we would have seen that corporate borrowers and other borrowers, the ratings keeps on changing, not very frequently, but over a period of time. So if there is a movement of rating from AAA to AA, in risk world, we call this as credit migration. So it's a credit migration risk. The credit is migrating from a particular level to the another level. This can also happen vice versa. We move on to question number 3. PD into LGD into EAD defines which of the following risk? So PD is probability of default, LGD is loss given default, and EAD is a exposure at default. Loss given default means how much money will be lost when there is a default. EAD means what is the amount outstanding when there is a default. This formula is used to calculate what is called as the expected loss. Having completed 4 questions, we move on to question number 5. Which of the following is our part of preventive steps of credit risk management? So, is it setting optimum level of rate of interest? Will that prevent credit risk? Buying insurance or asking for a collateral on loan? They are not preventive. Preventive is appraisal and borrower identification process. Let us move to question number 6. Apart from probability of default, which of the following factors play an important role in risk-based pricing of loan? Now, what is risk-based pricing? Risk-based pricing means that when you give loan to a borrower, depending upon the risk profile of the borrower, you charge him a particular rate of interest. So probability of default is one such factor, but what could be the other factor? So is it value of collateral or future business potential? Should one of them be considered or both of them be considered? So the answer is both of them are considered for risk-based pricing. But let me tell you that these are not the 3 factors alone which will decide. There are many other factors also. But in my question, I have only considered 3 factors: probability of default, value of collateral, and future business potential. Question number 7 talks about a formula. Adjusted income upon economic capital defines which formula? So in banking world, various formulas are used, but this particular formula refers to a very popular term called as risk adjusted return of capital. So economic capital's return is used, or rather economic capital return is calculated using this particular formula. So the answer is B here. We quickly move on to question number 8. Then there is a hyphen, is designed to ensure that banks build up capital during normal times, which can be drawn down as losses are incurred during a stress period. Now, as I told you earlier, that banks are supposed to keep tier 1, tier 2 and additional tier 1 capital, but RBI expects banks to also build up capital conservation buffer, which will help them during stress time. So the answer for this particular question is A. Counter-cyclical buffer are not built for that purpose, and tier 2 capital is anyway part of the normal capital. Tier 3 capital does not exist in the Basel framework. Which is the Basel III framework, I mean. Which of the following is not a credit event? So credit event means any such event which can cause a potential loss or may result into loss of non-realization of money. So restructuring is, repudiation is, bankruptcy is, but repayment is not a credit event. We will move on to question number 10. Which of the following type of derivative can be exchange traded as well as OTC? So forward contracts, they are always traded OTC. Future contract, they are traded on exchange. Swaps are traded OTC, unless you go into very specific definition of RBI. Here we are referring to option as a contract. In layman's term, this is what we like to say, that they can be traded OTC as well as on exchange. The exposure ceiling limits would be what percentage of capital fund for a single borrower and for a group borrower, or a borrower group. This has been very clearly mentioned by RBI as 15% and 40%. We go on to question number 12. Which of the following is deducted while calculating net worth of a bank? So net worth of a bank is calculated by taking into consideration multiple factors. Some of them are additions and some of them are deductions. In this case, it is the revaluation reserve which will be deducted while calculating the net worth of a bank. Question number 13 dash is potential for a loss in value of investment portfolio of a financial institution when an individual or group of exposures move together in an unfavorable direction. Now this could be an example of what is called as concentration risk, which means when you have exposure to an individual or a group of exposure that you have got, okay, they are moving together in an unfavorable situation. This will be because of the concentration that your credit portfolio has got towards that particular group. Let us move to next question. Common equity tier 1 capital must be at least 5.5% of risk weighted assets. This is what is expected as per Basel norms, which has been modified in India by RBI and made it as 5.5. This takes us to question number 15. Capital reserves representing surplus arising out of sale proceeds of assets form part of which of the following capital? So it's very clear that this forms part of the tier 1 capital. In tier 1 capital, we have different types of capital. We have share premium, we have reserves and surplus, and we also have capital reserves and statutory reserves, plus many other components. You need to go through that to prepare for exam, so that you can answer questions on capital adequacy, capital components, and related questions. Risk is defined as the gap between value predicted through the model and the value actually absorbed. So, various models are there to measure credit risk, market risk, and other risk components, but they may not always work effectively. So the model itself has a risk which we call as the model risk. So this is your answer for question 16. Move on to question 17. For all the bonds, duration is shorter than maturity, except for what type of a bond? I'm sure you know this, but let me tell that zero coupon bonds are the bonds for which duration is, except for them, all other bonds, duration is shorter than maturity. Now we move on to question 18. Which of the following is the measure of price sensitivity of a bond to interest rate movement? And this is again a very simple concept. It is arrived from Macauley's duration, and it's called as modified duration. So modified duration measures the price sensitivity of a bond to interest rate movement. It is calculated as Macauley's duration divided by 1 plus yield. Which of the following regulators regulate credit rating agencies in India? It's not RBI actually. Many people think it is RBI, but SEBI is the regulator for credit rating agencies. And we move on to question number 20. Which of the following is the current opinion on the probability of default of rated instrument? So remember, credit score is which is provided by the bureaus. That's not the case. That's not the answer here. Risk scoreboard prepared by banks are also not the answer. It is the credit rating. So we have completed 20 questions rather quickly. I will be coming out with more videos shortly. Okay, I will help you to prepare for the exam. I hope this video made some sense for you. Thank you so much for your time, and thanks for listening to this. Please do like my video and subscribe to the channel. Thank you.